Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I trust all is going well in your world. Markets actually overall in a big picture sense may be settling, calming down from that tremendous volatility of the last 2 to 3 months. That real whipsaw price behavior action. They seem to be calming, settling just a little bit, but certainly there's some big moves ahead of us, of course. On the data front, we've just seen in the US reasonable jobs report, but we also saw wholesale inventories. They're still down 12% for the year. And we saw sort of durable goods dropping 0.5% and other expenditures up 0.5% for a flat result really, or 0.1% lift. But we were down 0.6 the month before, and over the 3 months, we're down about 0.5% on wholesale inventories in the US. So very flat environment there on the inventory front, and still down 12% from a year ago. Of great concern on the US data was, of course, US consumer or US inflation expectations, what the consumers are thinking, and that jumped actually quite significantly from 4.2% to 4.7% in March. And of late, not always historically, but of late, that data series is a very good guide as to what the actual inflation number will be. Now, there's a few reasons for that. For instance, we have a situation where pricing has been through the roof. The consumer's been very hurt. A lot of consumers adjusting their spending patterns in the US as they are in Australia and elsewhere. And they have their eye on the ball, so to speak, in terms of prices at the moment. So it's front and center to their considerations. So in replying to surveys, they're paying a great deal of concern and focus and trying to get that expectation right. But what I've noticed, the highest correlation really, is gasoline prices. Gasoline prices move down, inflation expectations move down, inflation moves down. Gasoline prices move up, inflation expectations move up, inflation itself moves up. And that's what we've been seeing for several months now, and I expect that's going to be the case this time around as well, which means we're actually going to see a higher reacceleration inflation data print for the United States this time round. Yes, that's right, reaccelerating inflation again. We've already had a couple of months of reacceleration. I think we're going to get another one. Gasoline prices are now very tightly connected to the global oil price. And as we know, that's had a big leap higher, so gasoline prices will be almost immediately priced higher. Funny that, whereas when the global oil price falls, takes a little longer for the gasoline price to fall, but certainly the gasoline price moves up very quickly on the back of global oil markets rallying. So I think we are going to see that reacceleration in US inflation data, which means, yes, the Fed will be hiking interest rates. I can't believe some people are actually thinking this is a debate to be had. I think maybe it's just sort of to fill some copy or something. But yes, no, the Fed was always going to be hiking at this next meeting. I think it'll be hiking another 1, 2, even 3. Let's say 2 more meetings after this meeting. It's another 3 hikes, 75 points. That is not what the market thinks. So if our view is right, there's a trading opportunity here because the market isn't fully pricing, we believe, or I believe, isn't fully pricing the inflation threat that is ongoing and can actually reignite, if you like, on the back of the oil price. And the market isn't fully really adjusting pricing in the true course of the Fed funds rate. And of course, the market hasn't done that for a very long time. For about 18 months now, the market has got it wrong, consistently, badly wrong, in terms of its outlook on the Fed funds rate. So whatever the consensus view on the Fed funds rate has been badly wrong for a long time now. And I think what we're actually going to see is more of the market getting it wrong. In other words, we're still going to see the Fed funds rate go higher for longer than the market thinks. And those that talk about rate cuts, well, remember, we were supposed to have rate cuts last year. Then we were supposed to have rate cuts at the latest at the end of last year. Then we were going to have rate cuts at the start of this year. Then we were going to have rate cuts now, but we're not. So the market just gets it wrong and wrong and wrong again on this idea of the pivot, which I've always laughed about. Because when the Fed's finished raising interest rates, it's not going to be cutting interest rates. People think interest rates are high. They're low by historical standards. Where US interest rates, Australian interest rates in particular, still highly stimulatory. So the outlook for the Fed funds rate is another at least 25 points, but let's say another 50, 75 points higher. If inflation reaccelerates, it could even be another 100, 150 points higher, but there will be no interest rate cuts. The soonest I see an interest rate cut, I don't even see one actually. I just see a plateau, and then after about a year and a half of going sideways, there's more rate hikes. So maybe there will be some downside adjustment and then go back up. But overall, historically, we had sort of a 15, 18-year downswing in interest rates. And now we're in the first 12 to 18 months of a 15 to 18-year upswing in interest rates. That's the nature of the world. Oh, it's all different now, is it? Well, it's different in that interest rates are still stimulating the US economy, and the Fed still needs to hike them. And the Fed still needs to fight inflation in its own book. And in Australia, interest rates 3.6% is a non-event. That's still highly stimulatory. And today in Australia, we got data out from Westpac NAB suggesting a consumer and business leap in confidence, but still well down on where those levels were previously. But certainly a jump in consumer and business confidence when the Fed went on hold. When the RBA went on hold at its latest meeting. Now, that's all very well and good, but this data itself suggests will actually encourage the RBA to rekindle its hiking phase. The only thing that will stop further rate hikes by the RBA would be inflation dropping away. But the global oil price, after this consolidation pattern, after its big leap, again starts to head higher. And I wouldn't be surprised if oil had it's in this consolidation zone, if it kind of had a stab down, set off all the stops that are now built up on long positions below where we are, stab down, set off all the stops, and then the real buyers come in and oil goes through the roof again. Or the market is so taut, so firm, the global oil market, given that people are still concerned about the progress of the war in Ukraine, that it just leaps again from where it is now after a period of consolidation here, because it's been a very unusually tight sideways consolidation period in the global price of oil. So it's one of those two scenarios, but I do believe it does end higher, whichever path you take to get there. So that means ongoing inflation in Australia and around the world, and it means the RBA will have to start hiking interest rates again. The RBA's pause made no sense except to try and act like a caring person, a bit of a grandmother sort of approach by Governor Lowe, who likes to manage interest rates to the expectation of his surname. But we need more than that. We do need better than that. But I do think probably if I was governor of the RBA, I wouldn't have been doing what they've been doing. I would have raised rates a year ago gently to be at 2.5%, 2.8% now, and probably not have to be hiking now. But the RBA got it badly wrong, didn't do anything for too long, and now is chasing aggressively higher, exactly, precisely as we forecast 18 months ago. So, equity markets rallying on the idea this will be the last Fed hike. Oh dear, not so much. But it will take the market a while to figure that out. So there's an opportunity. I hope you have a good rest of the week. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.